This question tests students' understanding of how different cash transactions are classified in the statement of cash flows. The statement separates cash flows into three categories: operating activities, cash flows from normal business operations; investing activities, cash flows related to the purchase and sale of long-term assets and investments; financing activities, cash flows related to obtaining or repaying capital, such as borrowing money or issuing shares. The question presents two independent transactions: acquiring a long-term productive asset for $5,000 and borrowing $10,000 from a local bank. Students must classify each transaction separately according to its economic substance. Transaction 1. Acquisition of a long-term productive asset, $5,000. Purchasing a long-term asset, such as equipment or machinery, requires a cash outflow and is classified as an investing activity because it represents an investment in productive capacity. Transaction 2. Borrowing $10,000 from a bank. Receiving cash from a bank loan increases the company's financing resources. Therefore, it is a cash inflow from financing activities. A. Outflows for investing activities, $5,000. Inflows from financing activities, $10,000. Correct. This correctly classifies: purchase of long-term asset, investing cash outflow, bank loan received, financing cash inflow. B. Inflows from investing activities, $10,000. Outflows for financing activities, $5,000. Incorrect. The classifications are reversed. Borrowing money is financing, not investing. C. Outflows for operating activities, $5,000. Inflows from financing activities, $10,000. Incorrect. Purchasing a long-term asset is not an operating activity. D. Outflows for financing activities, $5,000. Inflows from investing activities, $10,000. Incorrect. Both classifications are incorrect. Correct answer: A. Outflows for investing activities, $5,000. Inflows from financing activities, $10,000. Exam tip: remember the OIF classification for the statement of cash flows. Operating activities, day-to-day business operations. Investing activities, purchase or sale of long-term assets, equipment, buildings, land, investments. Financing activities, borrowing money, repaying debt, issuing shares and paying dividends. A useful memory aid is: buy assets, investing; borrow funds, financing. Applying this rule: purchase of productive asset equals investing cash outflow, bank loan proceeds equals financing cash inflow. Thus, A is the correct answer. This question tests students' understanding of how the sale of investments is reported in the statement of cash flows. The key phrase is investing activities section. Students must distinguish between the gain or loss recognized in the income statement and the actual cash proceeds reported in the statement of cash flows. The company purchased the stock 3 years ago for $100,000 and sold it during the current year for $150,000. Although the company earned a $50,000 gain, the statement of cash flows reports cash received, not accounting profit. Therefore, students should focus on the cash inflow from the sale, not the gain. The facts are: original cost of investment, $100,000 selling price, cash received $150,000 gain on sale, $150,000 minus $100,000 equals $50,000. In the investing activities section of the statement of cash flows, the company reports the entire cash proceeds received from selling the investment, which is $150,000. The $50,000 gain affects net income and is removed from operating cash flow under the indirect method, but it is not the amount reported in investing activities. A. 0. Incorrect. Cash was received from the sale, so the transaction must appear in the investing section. B. $50,000. Incorrect. This is the gain on sale, which appears in the income statement, not the investing section of the cash flow statement. C. $100,000. Incorrect. This is the original purchase cost, which is irrelevant to the current year's cash inflow. D. $150,000. Correct. The investing section reports the actual cash proceeds from the sale of the investment, which equal $150,000. Correct answer. D. $150,000. Exam tip. For sales of long-term assets or investments, income statement reports the gain or loss, selling price minus book value. Statement of cash flows, investing activities reports the total cash received from the sale. A useful memory aid is cash flow statement records cash, not profit. Thus, cash received equals $150,000, investing activity gain equals $50,000, income statement adjustment. Therefore, the amount reported in the investing activities section is $150,000, making D the correct answer. This question tests students' understanding of the basic principles governing consolidated financial statements under U.S. GAAP. The keyword correctly illustrates requires students to identify the statement that accurately reflects consolidation rules. Under U.S. GAAP, a parent company that controls another entity, generally through ownership of more than 50% of the voting shares, must prepare consolidated financial statements, presenting the parent and subsidiary as a single economic entity. During consolidation, intracompany balances and transactions are eliminated because they do not represent transactions with external parties. Students should carefully distinguish between the requirement to consolidate when control exists, the elimination of intercompany transactions, and accounting methods that are unrelated to consolidation. Consolidated financial statements may use the treasury method of accounting. Incorrect. The treasury stock method is used in earnings per share, EPS, calculations for dilutive securities. It is not a method of preparing consolidated financial statements. B. Controlling interests in excess of 50% should be shown in consolidated financial statements. Correct. Under U.S. GAAP, ownership of more than 50% of the voting stock generally indicates control, requiring the parent to prepare consolidated financial statements. The subsidiary's assets, liabilities, revenues, and expenses are combined with those of the parent, while any non-controlling interest is presented separately within equity. C. Privately owned parent and subsidiary organizations are required to consolidate their financial statements. Incorrect. Although many private companies prepare consolidated statements, private companies may qualify for certain exceptions or alternative reporting frameworks. Therefore, the statement as written is overly broad and not universally true. D. Intracompany transactions are reported on consolidated financial statements. Incorrect. One of the fundamental principles of consolidation is that intercompany sales, receivables, payables, dividends, and profits are eliminated to avoid double counting. Therefore, intracompany transactions are not reported in the consolidated statements. Correct answer. B. Controlling interests in excess of 50% should be shown in consolidated financial statements. Exam tip. When studying consolidated financial statements, remember these key principles. Ownership greater than 50% of voting shares, control, consolidation required. Parent and subsidiary are presented as one economic entity. Intercompany transactions and balances are eliminated during consolidation. Non-controlling interests are presented separately within equity. A useful memory aid is control means combine, intercompany means eliminate. Thus, the statement that correctly reflects U.S. GAAP consolidation rules is B. This question tests students' understanding of the accounting method used for investments when the investor has significant influence but not control. The key phrases are: owns 25% of Company X's voting stock, has significant influence over its operating policies. Under US GAAP and IFRS, the accounting treatment depends on the degree of influence or control. Less than 20% ownership, generally fair value or cost method, unless significant influence exists, 0.20%, 50% ownership with significant influence, equity method. More than 50% ownership, control full consolidation. Since the investor owns 25% and can exercise significant influence, the investment should be accounted for using the equity method, sometimes referred to in older examination questions as equity consolidation. Full consolidation. Incorrect. Full consolidation is required when the investor controls the investee, generally through ownership of more than 50% of the voting shares. A 25% ownership interest does not normally provide control. B. Proportionate consolidation. Incorrect. Proportionate consolidation was historically used in certain joint venture situations under some accounting standards, but is not appropriate for an investment where the investor merely has significant influence. C. Equity consolidation. Correct. With 25% ownership and significant influence, the investor applies the equity method. Under this method, the investment is initially recorded at cost. The carrying amount is subsequently adjusted for the investor's share of the investee's net income or loss. Dividends received reduce the carrying amount of the investment rather than being recognized as investment income. Therefore, this is the correct answer. D. Variable interest entity consolidation. Incorrect. Variable interest entity, VIE, consolidation applies when an entity controls another through contractual or economic arrangements rather than voting interests. The facts given do not indicate a VIE relationship. Correct answer. C. Equity consolidation. In this question, 25% ownership plus significant influence clearly indicates the equity method, making C. Equity consolidation the correct answer.